there is a question that in recent years has occupied the minds of experienced investors, fund managers overseeing billions of dollars, and ordinary people simply trying to protect what they have spent decades building. The question is not simple, and the answer is even more complex than it appears. The American government is accumulating debt at a historic pace. Inflation has eroded purchasing power in a persistent and noticeable way. Geopolitical tensions have reached levels not seen since the Cold War. Central banks around the world have been buying gold in record volumes over the past several years. Each of these factors in isolation would point toward a significant appreciation in gold. Combined, they would create what many analysts would call an ideal environment for the metal. And gold has, in fact, reached recent nominal all time highs. That fact deserves acknowledgement. But the deeper question is not whether gold has moved higher, it is why, given such a powerful set of structural tailwinds, the metal still appears under responsive, less explosive than the full weight of the backdrop would seem to justify. That is the central question of this episode. We are not going to try to predict where gold will be in 6 months. That is not what we do here. What we are going to do is understand the system, the forces that structurally support gold, the forces that have been containing its advance, and what all of this means for someone who is seriously thinking about preserving wealth, protecting their retirement, and building genuine long-term financial resilience. Because understanding the system is always worth more than any price forecast. This is not a prediction I am making. It is a logical consequence of forces that are already in motion. Let us start at the beginning, not with the present, but with the past. Because history, when observed carefully, does not repeat exactly, but it rhymes with a disturbing precision. To understand why gold is where it is, you need to understand what money is, where it came from, and where it tends to go when systems begin to show fractures. Throughout most of recorded history, gold functioned as the most trusted monetary reserve asset that civilizations knew. Not because it was convenient for everyday transactions, copper, salt, and other goods served that purpose in different eras and places, but because gold brought together a set of properties that no other asset replicated with the same consistency: durability, relative scarcity, the impossibility of artificial manufacture, and universal acceptance across cultures and centuries. Gradually, monetary systems evolved. Two distinct mechanisms emerged, frequently confused with one another, but important to keep separate. The first were convertible certificates, documents issued by banks or treasuries that promised the holder the right to redeem a specified quantity of gold. Paper circulated as a substitute for the metal, but the promise of conversion was explicit and direct. The second was the fractional reserve system, in which banks held only a fraction of the gold deposited in their vaults and lent the rest, creating credit beyond what the physical metal could immediately back. It was a mechanism that expanded economic activity, but one that introduced a structural vulnerability, the possibility that promises could outrun the real capacity to honor them under pressure. In practice, these two arrangements coexisted in varying degrees throughout history, with different countries and periods leaning more toward one side or the other. What united them was the reference to gold as the ultimate anchor, what became known in broad terms as the gold standard, an arrangement that imposed a natural discipline on governments. You could not expand the money supply indefinitely without a corresponding base in metal. But governments, when they face crises, wars, recessions, social upheaval, need to spend more than they collect. And the gold standard was an inconvenient constraint on that necessity. The First World War was one of the first moments in which the major European powers formally suspended the convertibility of their currencies into gold to finance the war effort. Some returned to the standard after the conflict, but under increasingly fragile conditions. The Great Depression of the 1930s represented another significant rupture. In the United States, facing a severe banking crisis and the need to expand the monetary base to combat deflation, the federal government adopted a set of emergency measures that drastically restricted private gold ownership and suspended domestic convertibility. It was one of the most profound peacetime interventions in the relationship between the American citizen and money justified by the extraordinary circumstances of the era, but marking an important symbolic break. But the truly decisive moment, the one that defined the architecture of the global financial system in which we live today, came on August 15, 1971. That Sunday evening, President Richard Nixon announced that the United States was ending the international convertibility of the dollar into gold. Until that moment, foreign central banks could, at least in theory, present their dollars to the American Treasury and receive gold in return at a fixed rate of $35 per ounce. That was the foundation of the Bretton Woods system established after the Second World War. With the end of that convertibility, the dollar became a currency without external tangible backing. Its anchor became exclusively the credibility and the repayment capacity of the American government, what economists call fiat currency, from the Latin fides, meaning trust. The currency is worth something because the state declares it to be, and because markets sustain that premise. That was the effective birth of the modern monetary system in its current form. And what happened to gold after that? It appreciated significantly. In less than 10 years, it went from $35 per ounce, the fixed price of the Bretton Woods era, to more than $850. With the formal anchor removed, markets sought the asset that had historically served that function. It is worth noting something here that will become more relevant as we go. That nominal surge was dramatic, but what it truly reflected was a repricing of the real purchasing power of a currency that had lost its backing. Gold did not explode because gold itself became more valuable. It exploded because the dollar was worth less in real terms. That distinction is fundamental. But then came Paul Volcker, the chairman of the Federal Reserve, made an extraordinarily aggressive monetary policy decision in the late 1970s. He raised interest rates to levels approaching 20% per year with the explicit objective of breaking the inflationary spiral that was consuming the American economy. It worked. Inflation retreated. The credibility of the dollar was restored. And gold, deprived of its primary trigger, distrust in monetary institutions and fear of runaway inflation, went through decades of sideways performance. That sequence is not historical curiosity, it is an analytical pattern. History is an excellent teacher for those who have the humility to learn from it and the patience to wait for the lessons to repeat. Gold tends to appreciate when confidence in monetary systems deteriorates. It tends to stagnate or decline when authorities manage to restore that confidence, even if only temporarily or imperfectly. That is the cycle we need to understand in order to answer the central question of this episode. There is a common misconception worth correcting right from the start. Many people think that gold rises mechanically when inflation rises. That is a simplification that, in practice, fails with some regularity. Gold tends to appreciate when markets lose confidence in the real value of paper money, and especially when safe alternative assets stop offering adequate real returns. Inflation is one cause of that loss of confidence, but it is far from the only one. There are four structural forces that determine gold's behavior. Understanding them is essential for grasping both the tailwinds and the brakes that are operating right now. The first is the real interest rate. The real interest rate is the difference between the nominal yield on a safe asset, such as a U.S. Treasury, and the prevailing rate of inflation. If nominal interest rates are at 5% per year and inflation is at 3%, the real rate is positive 2%. The investor is being compensated in real terms for keeping capital in safe assets. If nominal rates are at 1% and inflation is at 5%, the real rate is negative 4%. The investor is losing real value even while receiving interest. Gold pays no interest. It distributes no dividends. It generates no cash flow. It simply preserves itself. When real rates are positive and robust, gold faces strong competition from safe fixed income assets. Why allocate to a metal that earns nothing when a U.S. government bond offers positive real returns? When real rates are negative or close to zero, that equation reverses. The opportunity cost of holding gold falls sharply, and the metal, as a store of real value, becomes comparatively more attractive. This mechanism is one of the most important individual indicators for understanding gold's behavior across the short and medium term cycle. Not the only one, but consistently among the most explanatory. The second force is the value of the US dollar. Gold is priced globally in dollars. That creates a structural inverse relationship between the two variables. When the dollar appreciates against other currencies, gold becomes relatively more expensive for buyers operating in other denominations. Global demand tends to recede. The dollar price comes under pressure. When the dollar depreciates, the opposite effect occurs. Gold becomes more accessible for global buyers, demand tends to increase, and the dollar price reflects that upward pressure. There is also a paradox that frequently confuses less experienced analysts. In moments of acute financial crisis, the dollar and gold often rise together because both are perceived as safe haven assets. This creates situations where gold appears undervalued relative to its fundamentals, simply because demand for dollars is also elevated. The third force is institutional buying by central banks. This is perhaps the most significant structural shift and the least publicly discussed of recent years. Central banks around the world, with particular emphasis on those of emerging economies such as China, India, Turkey, Poland, and several countries in the Middle East, have been buying gold in historically extraordinary volumes. 2022 was the year with the highest volume of net gold purchases by central banks in all of recorded market history. 2023 was the second highest year of net purchases ever documented. We are not talking about a marginal trend. We are talking about a deliberate strategic repositioning at global scale. Why are these countries buying gold in such volumes? Because they are systematically reducing their dependence on the US dollar as a reserve asset, because they watched closely what happened to the Russian central bank's reserves after the Western sanctions of 2022 assets denominated in dollars and euros were frozen practically overnight, because gold is a neutral asset. It is not issued by any government. It is not subject to third-party sanctions, and it does not depend on any specific financial infrastructure to preserve its value. This structural demand from central banks represents a long-term tailwind that did not exist in previous decades with the same intensity. It is a change in architecture, not in sentiment. The fourth force is the demand for systemic protection. In periods of great geopolitical uncertainty, of instability in banking systems, or of broader institutional crises, a portion of investors directs capital toward gold not for reasons of refined financial calculation, but for reasons of structural prudence. Gold is the reserve asset that preceded every central bank, every modern financial system, and every fiat currency in existence today. In moments when those systems appear vulnerable, the metal offers an anchor that transcends confidence in any specific institution. If you understand incentives, you understand behavior. If you understand the structural fears of the major actors, you begin to understand where protection capital moves during cycles of greater uncertainty. With that framework in mind, we return to the central question. If the structural fundamentals are so favorable, recent nominal all time highs already recorded, record central bank purchases, debt at historically elevated levels, persistent inflation, why does gold still appear to fall short of what the full weight of those forces would justify? The answer lies in a set of containment forces that have, for now, balanced the tailwinds. The first break was the Federal Reserve's restrictive monetary policy. Between 2022 and 2023, the Fed executed one of the fastest and most aggressive monetary tightening cycles in the past 4 decades. The stated objective was to control inflation that had escalated to levels not seen since the 1980s. In large measure, that policy worked. Inflation retreated from its peaks. But the direct side effect was that U.S. Treasury securities, especially short term ones, began to offer significant nominal yields. Combined with the decline in inflation, this meant positive real rates for the first time in years. For many investors, that was an attractive proposition. Positive real returns with essentially zero sovereign risk. Gold, which offers no yield at all, lost relative competitiveness in that environment. It is a temporary break, but a real and measurable one. The second break was the structural resilience of the U.S. dollar. Many analysts anticipated that the accumulation of American debt would accelerate the dollar's deterioration. That thesis may still materialize, and there are solid arguments that it will at some point in the long cycle, but it did not happen at the expected pace or magnitude. The reason is fundamentally relative. The euro faced its own structural challenges. The Japanese yen went through one of the largest depreciations in its recent history. The Chinese yuan operates with limited convertibility and capital controls. The British pound went through periods of significant instability in a world where virtually every major currency presents its own vulnerabilities. The dollar, even with its fiscal imbalances, remained the preferred destination for global capital seeking relative safety. A dollar that resists the expected depreciation exerts containment pressure on gold. It is a mechanical and well-documented relationship. The third break was the marginal fragmentation of protection flows. It is worth registering a relatively new phenomenon. A portion of the capital flows that historically would have directed themselves entirely toward gold as a reserve asset has begun to be divided with digital assets, particularly Bitcoin. This is not a dominant force, and it is important to be precise about that. Gold possesses structural advantages that Bitcoin has not yet replicated. Centuries of universal acceptance, deep liquidity across all markets, the absence of technological and regulatory risk, and recognition as a sovereign reserve. It is not a substitution, but it is a marginal fragmentation of demand that, at the edges, has reduced the growth of gold's buyer base relative to what previous cycles would have suggested. The fourth break was the normalization narrative that persisted longer than expected. For much of the past several years, markets operated under the hypothesis that the inflationary crisis was transitory, that rates would return to prior levels, that the Fed would find its way back to more accommodative conditions, that the system would stabilize within familiar parameters. When investors believe in normalization, they allocate to growth assets, equities, real estate, private equity rather than preservation assets. Gold has its most meaningful performance when markets revise downward the probability of normalization. When the prevailing perception shifts toward the view that structural conditions have changed in a more durable way, that moment may be closer than markets are currently pricing. There is an analytical framework that helps clarify the markets and economic history with greater precision. We can call it the Great Debt Cycle, or, in broader perspective, the cycle of monetary empires. Throughout recorded history, every great economic power has followed a recognizable pattern. It rises from solid foundations: productivity, innovation, fiscal discipline, and trustworthy institutions. It becomes the global financial center. Its currency becomes the dominant reserve currency over time, and gradually it begins to spend beyond its capacity to collect revenue. It accumulates debt. It resorts to monetary expansion to finance its deficits. The currency begins to lose real value. International confidence deteriorates slowly, and eventually, not in a single event, but in a process that unfolds over decades, the global financial center of gravity reconfigures itself. The United States today stands at a specific and clearly identifiable moment in that cycle. U.S. Federal debt is approaching $39 trillion. Interest payments on that debt have grown to represent one of the fastest growing spending commitments of the federal government, a self perpetuating dynamic. More debt demands more debt service, which pressures the public accounts further over time. The American fiscal deficit is not a short term dysfunction. It is a structural trend driven by long term obligations, healthcare programs, Social Security, and growing debt service that advance independently of the policy choices of any specific administration. What happens historically to a country facing structurally growing debt and persistent deficits? The answer is not an abrupt collapse, it is a gradual erosion. The currency loses real value over decades. Real assets, those whose worth does not depend on government promises, undergo progressive revaluation. If you observe carefully, you will notice that what appears exceptional today is frequently just the phase of the cycle that has not yet completed its arc. The great monetary adjustments rarely happen in a single day. A data point that helps calibrate this perspective: in 1971, when Nixon ended the dollar's convertibility into gold, 1 ounce of the metal cost $35. Today it costs more than $2,000 in nominal terms. But the most precise way to interpret that figure is that the dollar has lost real value over 5 decades, and gold, measured by what 1 ounce can acquire in concrete goods, has remained comparatively stable. What changed was the measuring stick, not the metal. That distinction between nominal appreciation and preservation of real value is the heart of the argument. Gold is not an engine for wealth creation. It is an anchor of monetary integrity, the difference between storing wealth in a container that maintains its substance over time or in one that loses content slowly and almost invisibly. Let me tell a hypothetical story that will make these patterns more concrete. Imagine a country called Orantia. For decades, Orantia was the most powerful and stable economy in the world. Its currency, the Arant, was accepted in every global transaction. Any country that needed to buy energy, technology, or strategic commodities first needed to acquire orants. Orantia's citizens lived well. They bought homes, educated their children, and built comfortable retirements. Inflation was low. Growth was consistent. But over the decades, Orantia's government made decisions that individually seemed reasonable, but that taken together formed a troubling pattern. It began spending systematically more than it collected, financing social programs and external commitments under the justification that future growth would balance the books. When the economy slowed, the central bank expanded the supply of orons to stimulate activity. Debt grew. The cost of servicing that debt grew. The need for additional issuance followed, a self reinforcing cycle. Ordinary citizens, teachers, nurses, retirees noticed that their salaries bought progressively less. The cost of living rose in ways that found no clear precedent in their personal memory. The government said inflation is under control. Financial markets moved higher. Meanwhile, silently, the central banks of other countries began reducing their exposure to orants. They bought gold. They diversified into assets that did not depend on the credibility of any specific issuer. It was not a dramatic rupture. It was a slow change of tides. The citizen of Arancha, who had kept all of his wealth in orans, gradually realized that his purchasing capacity had been eroded, that the neighbor, the one who seemed excessively cautious for keeping a portion of his wealth in metals and real assets, had preserved something that paper money could not hold. Orantia is fiction. The pattern it illustrates is not. It is a cycle that has repeated in different forms throughout economic history. The relevant question is not whether this cycle will complete itself. The question is what part of the cycle you are in and whether your portfolio reflects that awareness. Moving away from historical abstraction, let us speak directly about the scenario that matters. The American aged 40, 50, 60, or 70 who is seriously thinking about how to protect what they have built. You likely have most of your wealth concentrated in a few asset classes. A 401k or IRA invested predominantly in American equities, perhaps real estate, perhaps some cash reserves. All of these assets share one characteristic: they are denominated in US dollars and depend to varying degrees on the stability of that currency's real purchasing capacity over time. And you have probably felt in recent years something that goes beyond the numbers, the sensation that money is worth less, that the prices of essential goods have risen in ways that find no clear precedent in your personal memory. That perception is not paranoia. It is the correct reading of a real process. The gradual erosion of the dollar's real value over prolonged cycles. What history shows in a qualitative and consistent way is that those who kept the entirety of their wealth in fiat currency over decades invariably surrendered real value, and those who maintained a portion in real assets, gold, real estate, commodities, tended to better preserve the integrity of what they had built, not because those assets are vehicles for high growth, but because they function as anchors in portfolios that would otherwise be entirely exposed to the consequences of monetary policy decisions by governments with structural incentives to expand the money supply. The risk that most people do not calculate adequately is the risk of being correct in the short term and completely mispositioned over the long run. Real diversification across asset classes with genuinely distinct behaviors is the most honest answer to that problem. There is also a concentration risk that frequently goes unnoticed. Most Americans have their wealth concentrated in American assets, denominated in US dollars, equities and real estate, essentially. Two asset classes that, despite their differences, share a common vulnerability: the gradual erosion of the real value of the currency in which they are denominated. Gold, as a global asset with no denomination in any specific currency and no dependence on the performance of any particular economy, offers a form of structural decorrelation. It is not the only available answer, but it is an important part of a complete one. Let me be direct from the outset. I am not a financial advisor, and nothing I say constitutes personalized advice. Every situation has its own variables. What I can do is articulate the principles that guide the thinking of those who have navigated decades of market cycles, crises, and recoveries. The first principle: think in terms of a resilient portfolio, not bets on specific assets. The productive question is not, should I buy gold? The productive question is my current portfolio built in such a way that different economic scenarios, more persistent inflation, recession, a weaker dollar, geopolitical instability cannot destroy me simultaneously? That is what real diversification means. Not diversification across different American equities, but across asset classes that behave in genuinely distinct ways across different macroeconomic environments: equities, bonds, real estate, precious metals, other real assets. Each has a distinct performance profile depending on the inflationary environment, the credit cycle, and the degree of confidence in monetary institutions. A well constructed portfolio is not one that maximizes returns in a single favorable scenario. It is one that maintains resilience across multiple plausible scenarios. The second principle: build structural protection, not short term timing. One of the most common traps is waiting for the perfect moment to build the protection position, waiting for the price to fall, waiting for a definitive signal. The problem is that the moments of greatest demand for reserve assets coincide with the moments of greatest uncertainty, precisely when buying feels most terrifying. The rational approach is to build a gradual and deliberate exposure over time as part of a structural allocation strategy, not as a tactical bet based on short term forecasting. You do not buy insurance during the fire. You buy it before, calmly, when the cost of building that protection is reasonable. The third principle: understand exactly what each instrument offers. Physical gold bars and coins offers the most direct and unmediated exposure to the metal. For those who prioritize protection in scenarios of severe systemic stress, it is the purest form of access. Gold backed ETFs offer convenience, liquidity, and lower custody costs. For most individual investors, they represent a reasonable balance between practicality and real exposure. Gold mining equities offer leverage to the metal's price, amplifying both gains and losses, and add company specific operational risk. They are instruments with distinct characteristics suited to well defined profiles and objectives. Understanding these differences is not a detail. It is an essential part of the financial education that any serious investor needs. The fourth principle: calibrate the proportion to your time horizon and your exposure to systemic risk. The logic is straightforward. The greater your dependence on accumulated wealth, the shorter your time horizon, the lesser your ability to absorb temporary losses, the greater the proportion that should be allocated to preservation and protection assets. There is no universally correct percentage. There is a logic that needs to be applied to your specific situation with your time horizon, your income sources, and your long term objectives. The fifth principle: review and rebalance periodically. A portfolio is not a static decision. Markets move. Your personal situation evolves. Macroeconomic conditions change. A periodic review annually, at a minimum, to verify whether the proportions still reflect your objectives and your reading of the economic environment, is one of the simplest and most effective practices in long term wealth management. We have spoken about the past, we have established the principles. Now, with the intellectual humility that this type of analysis demands, let us examine the structural trends that are already in motion. These are not predictions. They are logical consequences of identifiable dynamics. The first trend: real interest rates should give way over the course of the cycle. The Federal Reserve cannot sustain elevated nominal rates indefinitely in an environment of growing federal indebtedness. The cost of each additional percentage point of interest multiplies across a debt base that continues to expand. As the tightening cycle completes and nominal rates recede, whether due to economic deceleration, fiscal pressures, or both, the opportunity cost of holding yielding reserve assets diminishes, and the argument for gold as a real value anchor strengthens progressively. Historically, cycles of falling real rates have been among the most consistent catalysts for the metal's appreciation. The second trend, the diversification of global reserves, will continue to advance. The process of gradually reducing dependence on the dollar in central bank reserves, frequently called de-dollarization, is a structural long-term trend, not a conjunctural phenomenon. This does not mean the end of dollar dominance. The dollar will likely remain the primary global reserve currency for decades, but dominance is not exclusivity. As the dollar's relative share of global reserves edges lower, structural demand for alternative assets, including gold, increases in a sustained way. The third trend, the geopolitical environment, will remain more fragmented. The world is reorganizing into blocks of influence with less economic interdependence than in previous decades. Global supply chains are being restructured along national security criteria. Trust between the major powers is at its lowest points in decades. In that kind of environment, neutral assets, those that carry no political risk from any specific issuer, tend to be more sought after as strategic reserves by governments, institutional investors, and individuals alike. The fourth trend, America's structural fiscal pressures have no simple political resolution. Regardless of which party holds power, the long term obligations of the U.S. federal government, growing debt service, healthcare and social security programs with unfavorable demographic profiles represent pressures that intensify automatically over time. The historical response to this type of chronic fiscal pressure is almost never prolonged and successful austerity. It is, in general, some combination of financial inflation, financial repression, and the gradual devaluation of the currency in real terms over years and decades. In all of those scenarios, reserve assets with independent intrinsic value have historically fulfilled their protective function. I am not claiming that collapse is inevitable. I am saying that the structural pressures are real, that the historical patterns are recognizable, and that building resilience for multiple scenarios is always superior to betting on a single outcome. Why, then, has the adjustment not occurred in a more expressive way? Because these processes unfold over time horizons that are longer than short-term markets anticipate, because the containment forces are still active, even if progressively more fragile, because markets frequently take longer to incorporate structural shifts than fundamentals would justify. But when the brakes weaken, when real rates recede, when the dollar loses relative strength, when an event of sufficient magnitude forces a revision of the stability narrative, the adjustment tends to come faster than those who stayed on the sidelines can react. There is something analytically revealing in the position gold occupies in monetary history. It does not produce, it does not grow, it does not innovate, it distributes no dividends, it hires no employees, it launches no products. And yet, for more than 5,000 years, across radically distinct cultures and continents separated by oceans, gold has been recognized as the most enduring reserve asset that humanity has known. The reason is structural, not sentimental. Gold cannot be created by political decree. It answers to no monetary authority. It cannot be expanded when a government needs to finance a deficit. It carries no issuer credit risk. It exists independently of confidence in any specific institution. In a system where money is created by the decision of central authorities and where the structural long term incentives consistently favor the expansion of the money supply over fiscal discipline. The existence of an asset that cannot be diluted carries a value that goes beyond short term pricing models. Gold is not an asset for someone trying to build wealth quickly. It is an asset for someone who understands that money has a history, that systems have cycles, and that preserving the real integrity of wealth across different possible monetary futures is worth more than maximizing returns within a single optimistic scenario. When you observe gold and find that, even having reached recent nominal all time highs, it still appears to fall short of what the full fundamentals would justify. Remember that markets operate predominantly in the short term. Real wealth, the kind you want to preserve and eventually transfer, operates over the long term. And over the long term, the central question is not knowing where gold will be in 6 months or a year. The question is more fundamental. Across which possible monetary futures do you need part of your wealth to maintain real integrity, and what proportion of your assets is genuinely prepared for those scenarios? If the global monetary system continues operating without significant structural adjustments, growth assets will tend to perform well, and gold will fulfill a modest role as a portfolio stabilizer, a good result. If the system moves through prolonged financial repression, persistent structural inflation, or gradual real devaluation, gold will fulfill exactly the function for which it has been recognized across centuries: a reserve of monetary integrity, an anchor of value in an environment where the worth of paper is decided by others. Also, a good result for those who were positioned beforehand. Building real resilience does not require knowing which of those futures will materialize. It requires constructing a portfolio that maintains its substance through both and through others we cannot yet anticipate with clarity. Gold is not a bet on tomorrow's price. It is a reserve built with the awareness that the monetary future holds multiple possible outcomes, and that wisdom lies not in predicting which one will arrive, but in not needing to be right. There is no artificial urgency here, but neither does the perfect moment exist, the one that waits indefinitely on the horizon. There is only the deliberate decision to build protection calmly, with knowledge, and with the clarity of someone who understands that cycles run their course with or without our approval.